Hi and welcome to our first investment themes of 2016. In December, the Federal Reserve raised interest rates and we have seen a wobbly start to the year. Now, with falling oil prices affecting energy stocks and the global economy. I'm here today to take a look at the economic outlook with Mark Burgess. Hi Mark, great to see you again.
Hi Deborah.
Well, we've got plenty to cover today. There's been a lot of factors that have been affecting the markets recently. Let's start with China. Is this set to continue, Mark?
We've seen clearly, as you say, markets been impacted by events in China and investors grappling with what a slowdown in China means for both the global economy and world markets. We think the rebalancing in China will be ongoing. China massively expanded its credit and investment spending in the aftermath of the financial crisis, and it's reining back from that now and endeavouring to rebalance its economy away from investment spend and towards consumption, and that will lead to lower GDP growth, and that has other implications for the global economy. So yes, we do think that's an ongoing phenomenon.
Now, there's been a lot of movement in markets. Who are the winners and losers?
Well, clearly the commodity markets have been the losers. We've seen dramatic falls, particularly in the oil price, as demand has fallen away, as China slowed down, and that has impacted the emerging market producers of the commodities, and it's also impacted energy companies across the globe, but in particular shale oil companies in the US. So those are unequivocal losers. Winners would be the developed market consumer. The fall in the oil price is like a big tax break for the developed market consumer, and with the fall in gasoline and petrol prices that we've seen, then we expect consumption spend to be strong both in North America and in Europe.
Okay. What is value and how do you seek it with your investments?
Well, I think we're grappling with what the global slowdown might mean for corporate profits and what that might mean for the outlook for interest rates. We saw the first rise in interest rates at the back end of last year. Indeed, I remember talking to you about it at our last meeting.
We did, yes.
And so we're thinking about what that might mean for interest rate rises and what that might mean for corporate profits. There's no doubt that profit expectations have been downgraded. So we're trying to factor that into our valuation models and think about where value might now lie in equity markets and where it might lie in bond markets.
Now, you've touched on emerging markets before. How are they performing?
Well, they've been performing very poorly for some time. The relative strength of the US economy has led to significant outperformance of the US dollar, which has placed quite a lot of pressure on the emerging market currencies. And so we've seen sharp falls in many of the emerging market currencies, which in conjunction with the fall in commodity prices that many of them produce, has placed very significant downward pressure on those economies, and we're kind of figuring out what that might be.
Yeah.
I don't think we've bottomed that out yet. I think there's more to go, and I think the emerging markets will stay under pressure for some time yet.
Do you know how policymakers are trying to help this situation?
Well, certainly the outlook for interest rates has softened. The Fed was expected to raise interest rates 4 times in 2016. We think it's going to be less than that now. The Bank of England have said that they can see no immediate reason to raise interest rates. Certainly the market doesn't expect UK interest rates to go up until the end of 2017. Okay. And in Europe we don't see an interest rate rise for many years. So interest rate expectations have certainly softened.
Now, Mark, you've mentioned consumer spending before. Can you explain us a little bit more about the situation here? So
consumption as a percentage of GDP in both North America and to a lesser extent Europe is a significant percentage of the economy. Consumption is 70% of the US GDP, and it's anywhere between 50 and 60% in Europe. So when they have a fall in the cost of their energy bills, a fall in the cost of their transportation bills via gasoline and petrol prices, then they can spend that money on other things. Yeah. And we've seen that they are doing that. Consumption spending has been picking up, and also we've seen a rise in the savings rate as consumers have also saved some of that windfall, and that's also positive for the economy in due course.
Are you expecting that trend to continue?
We think as consumers become more confident that the oil price is not going to rise from here, and certainly our expectation would be that if it will only rise modestly from here, that they will start to spend more of that windfall, which will provide a decent underpinning to the economy.
Okay. Well, thank you very much for your time, Mark. And thank you for watching. We look forward to seeing you again next month.